hopefully everyone likes data, especially during a turbulent market in this beautiful title I came up for this speech. When we look at data though, and I guess I'll back up, my name is Kyle Stanford. I lead our venture research team at PitchBook, the leading data provider for the private markets, including VC, PE, and M&A. When we look at private market data and look at kind of a dynamic market in a static but long-term market, it becomes very difficult to decipher what is actually happening and what are the underlying trends when you look at just fundraising, right? Fundraising this year is lower than we've seen in a decade. The last year was a record. Exit value is lowest we've seen since the financial crisis. But 2 years ago, the global venture market created $1.5 trillion in exit value for its investors and LPs. A better way to look at the data is to look at the challenges that the current market has. And what are the influences that are creating those challenges, and how the actual structure of the market is set up for future growth or further decline. We look at three major challenges in the market today. The first one is something you probably all heard about: capital availability. It's low, but we put actual data point to that. By looking at historical deal count trends and deal size trends, we estimated the amount of capital that should be demanded by the market today, and actually looked at what is being invested during that time. At the late stage globally, Series C, Series D, around there's a 2.8x deficit in the amount of capital that is demanded by startups and what's actually being invested. Huge problem for startups, especially when you look at the second problem. 140,000 startups today are privately VC backed. The number of companies that have raised capital in the last 4 years has doubled. 140,000 companies are now looking for data or looking for capital from investors. And even as we look at record amounts of dry powder, about 550 billion globally, investors are being patient because the last couple of years have been so hyped up and has had so much investment activity. The third challenge here that we see in the market today is much more focused on companies, and they're a challenge for those companies. Today's market is more investor friendly than it's been in more than a decade. What does that mean? Term sheets are coming in with high liquidation multiples. They're coming in with cumulative dividends that are going to be paid out no matter what. They're coming with these investor protections that are making it much less risky for investors to invest. But even those deals that are coming with high valuations are much more dilutive to founders and much more destructive down the road if those companies aren't able to exit at a high valuation. So what are the influences, right? We can talk about the challenges all day, and that means relatively nothing unless we talk about how those came into the market. 2 years ago, when deal flow was high and capital was very abundant, what was happening? The public markets were ripping higher. Private markets and public markets become more intertwined than we've ever seen in the past. When we look at companies that were VC backed and recently went public, we can see the challenges that investors are looking at these companies with. Many of the companies privately backed today were built on a growth at all costs mindset. Uber had heavy losses when they went public. That's not going to fly today as companies look to IPO and investors look at their balance sheet and price those companies on a much different scale. At the top in this dark blue line, the VC-backed IPO index is barely up over the past 3 years. That's not a huge signal of confidence. The D-SPAC index is down 70%, and hopefully we can call SPACs dead. Looking at another influence, the first thing that happened as the public markets declined was crossover investors. The largest investors in VCs pulled out of the market. These investors have been hugely influential for the growth of VC over the past few years. Not because of their innovative strategies or their ability to help early stage companies, but because of the large amounts of capital that they have and are able to invest in single deals. As companies stay private longer, they are no longer able to be solely invested or solely capitalized by VC firms. In the US, there are a lot of new billion-dollar funds, but only 60 investors in the US have ever raised a billion-dollar fund. And making a new deal in a unicorn is not going to give the return profile that many of those investors need. These crossover investors were there to invest high amounts really quickly in high growth companies. And they were getting the return they wanted. They were returning double their investment in under 2 years. So adding this opportunistic strategy to their large portfolio was an easy bet. But without them, deal value trends suffer. We can also look at the valuation. We look at, using our IPO index, we look at the price to sales multiples of those companies and how they have changed over time. Especially when late stage and venture growth stage companies are priced, their public comparables are one of the major factors in that pricing. If the revenue multiple is high, that private company is likely going to get a high revenue multiple as well. But now that these public multiples have snapped back to under 5x, many of the companies that are even still exhibiting growth in revenue as private companies are coming back to a market that is much more formidable and likely to give them a much, much lower valuation than they would have found 2 years ago. That is making the deal making difficult. Overall, when we talk about the public market influence on the private markets, IPOs are, the easy catalyst or the easy fixture to see between the two. It's been over 24 months since the number of IPOs globally has surpassed the number that we have estimated using our data. There's a huge amount of companies that are ready to go public but can't because the public markets are valuing them much differently than they've raised over the past few years. 450 companies globally is our estimate for the number that are waiting to go public but yet can't because of the private markets or because of the public market problems. So what are left with these companies? These companies are left with poor options for exits. Unicorns are more likely to IPO than they are to get acquired, especially in the US when antitrust laws and regulations and scrutiny is much higher than it has been in the past. Microsoft, Adobe, Google, these companies can't acquire these unicorns like they might have wanted to in the past. But these unicorns also can't raise capital. Without those crossover investors, they're stuck between no exit possibilities and no fundraising possibilities, leaving them to extend their runway as best they can. Layoffs, debt, any sort of non-dilutive financing that they can make their cash runway lengthen is what they've been doing. So if those are the influences in the market, again, we need to take a step back here and be like, all right, how is the market structured now to move forward? Is it going to grow over the next few quarters? Is it going to decline even further? The jury's still out. Venture market is very slow moving, right? We want it to be an immediate change. Public markets drop. We want it to be immediate that the private markets are also going to show the exact same problems as the public market. This is probably very unsurprising, but deal count is down, right? Deal count is down 30% on an annual basis from what it was 2 years ago. But on a quarterly basis, it's higher than it has ever been before 2021. 5,000 funds have launched in the last 3 years, a huge number of investors that are still within their new investment period. This is keeping deal counts relatively high, again, higher than any quarter before 2021, even as that deal value is coming down. Crossover investors aren't here. Deal value trends also won't stay afloat. This is looking at recent deal count trends. As you can see here, it just recently crossed the long-term trend as far as a decline in quarterly deal count. The venture market is structured in a very strong way moving forward. Again, 5,000 funds have been raised in the last few years. 550 billion in dry powder is available, but it's available for the right companies. And that 140,000, they're now scrambling in crowded markets, crowded sectors to get some of that capital are having a much more difficult time than they did 2 years ago. Valuations are another thing. But again, seed, last quarter was the highest median seed valuation we've seen globally in our data set. In the US, the median seed valuation in Q1 of this year was $13 million. Indexing these by stage back to 2017, and the only stage that has a lower valuation than 6 years ago is venture growth, our Series E and later companies, those unicorns, those companies that are very reliant on the non-traditional capital. Those are where the valuations have dropped. Exit activity is another one that is very influential over the future of venture, right? Without that capital being recycled to investors and LPs, there will be less capital moving back to funds moving forward. We are looking at an annualized figure in 2023 that is less than 5% of what was created in 2021. But that $1.5 billion is not distributed immediately. Many of these companies are still held within portfolios. That capital will be distributed to LPs over the next 6 months or a year. There is much more capital to be recycled into VC than just what is being exited in 2023. One-year horizons for VC funds don't look good either. But there's a lot more to that than just what is happening in 2023. The returns of venture over the past decade have been the highest of any private strategy except for growth equity, which also includes a lot of those unicorns that many of these companies were investing in. Venture has returned trillions of dollars to investors over the last decade, which has created that swell in 2021 that we saw. While no one likes to see it negative here, these IRRs will bounce back if the IPO window is able to start accepting these companies. One reason we haven't seen many tech companies file their S1s is because they were built on growth at all costs. Now when everyone wants profitability or path to profitability, it takes time and money for these companies to restructure their balance sheets, restructure their growth prospects, to make public investors look at them and price them as they would many of the other companies that they're investing in. We do not expect the IPO window to open up this year. I think we're well on our way to a mid-2024 time where companies are able to start public listing. But Kava's recent listing is a win for the tech industry. Even though it wasn't a tech company, it's a fast casual restaurant. The high premium that has been placed on it by public market investors is a win. I guess we could also say that the IPO market, the sentiment couldn't be any lower, so it is what it is. But we'll be looking for those tech companies to IPO or file their S1s over the next 6 months and see what's actually under the hood of all these companies. If there's a silver lining in anything for the venture market, it is probably the most well-capitalized it has ever been. $770 billion was invested globally in 2021. $530 billion was invested globally in 2022. More than half of those 140,000 companies that are VC-backed right now have raised within the last 18 months. Add in there the debt and non-dilutive financing that is available now, and these companies have a much longer runway than they've ever had in the past. We've expected down rounds to tick up, and they have jumped only slightly. Still under 10% of the rounds that are completed on an annual basis are down rounds. That may change by the later this year as these companies need to come back to the market. But from what we can see right now, the market is very well capitalized. For one last thought I will say is that the venture market of the past decade has grown from a 40 billion global market to $750 billion market that happened in 2021. Large major institutions have taken notice as well. The last few months, BlackRock, Blackstone, JP Morgan have all increased their exposure to VC, taking this slowdown as a way to take a larger stake. The next bull market in venture will not be built on emerging managers or VCs alone. It will be built on the backs of major institutions that want a piece of venture. Again, my name is Kyle Stanford. All of the data in this presentation was pulled from the PitchBook platform. So thank you very much.